The benefit of some of those who have logged in and registered with our investor relations time for the very first time, I will just dwell very briefly on the corporate structure of the bank, highlighting perhaps one or two slight changes from the previous quarter. You have on this particular PowerPoint slide the corporate structure of the bank on the top right hand side. The key difference is that this year we have divested our 35% equity investment in the Maldivian finance and leasing company, which we held jointly with IFC. Collectively we owned 60%, and having owned it for close to a decade, the two investors felt that the strategic objectives of our investment has matured, and it's time to make way and hand it over to some local investors. So we exited towards the end of March 2014, and the structure now has the bank as the key engine, and the other main engine being our investment banking group, which is championed by the NDB Capital Holdings PLC. The Bangladeshi investment currently is owned under the bank, but we are constantly evaluating the merits of keeping it under the bank or to flip it under the ownership of the investment banking holding company. And when there is some further information to share, we will keep you informed. So in summary, the first chart shows you the full 2013 numbers. Just to recap where we were, we ended the year with a very strong capital at 15% Tier 1, 21% total capital, NPLs at just under 2.5%, a loan book in excess of 141 billion, and crossing the asset base of 200 billion, exceeding it to 206, and exception adjusted return on a profit after tax of 2.7 billion. So moving forward for the first quarter, we have some interesting numbers. The operating income, which comprises of the net interest income and other income, has grown by 31%, driven equally by NII as well as our other income, fee income. Profit attributable to ordinary shareholders rising by 141% to 1.2 billion. Earnings per share going up by 134% to just under 30 rupees per share. The loan book reaching close to 150 billion at 149.8, which is an annualized 25% growth, which is very much in line with our budgeted plan. The deposits have also grown by 23% in line with the annual expectation to 135 billion, and a very strong total capital of 20.3%. The NPLs have seen a marginal rise from the previous to 2.69%, but this is still about 40% of the industry norm, which is now around 6%. This still, I think, leaves room for further consolidation, and that's one red arrow which we will be focusing very much on the next 2 quarters. So overall, I think a happy overall quarter. In this particular chart, the top graph shows you the composition of operating income. The total 31% growth is broken into NII and fees. We see a 14% year-on-year on net interest income, despite pressures on margins. The fees and income, which is attributable to core banking, has shown a 54% rise. Good contributions coming from the areas such as trade finance, loan fees, etc. And then a trading income, which is your forex-related trading, shows a 68%. And we also have some good contributions coming from the management of the balance sheet in terms of some trading in government securities. So an overall pleasing 31% growth, where the contribution of the non-funded increasing from 33% in the previous first quarter of 2013 to an interesting 42% during first quarter 2014. We are very pleased with the improved contribution from the non-funded income, and this is a strategic priority of focus to offset any perceived threats on reducing interest margin. So this is one area the management team would continue to focus during the remaining 3 quarters. Let me move on to the margins, the chart. So the top left hand shows you industry against NDB, and you can see the amber chart showing you the gradual decline NIMs of the industry, which has come down from 4.2% in 2011 to 3.2, so almost 100 basis points in the last 3 years. NDB has managed to defend it almost to a flat from 3.7 to 3.5, and this is something we believe we are continuously focusing on in trying to defend where we are. The after-tax growth again has shown an impressive 141% in the last year-on-year, which is again quite pleasing. The efficiency levels, the bottom left-hand side graph shows the industry cost to income gradually rising from 51% in 2011 to 55%, while NDB has interestingly and progressively reduced its cost to income from 50% in 2011 to 44%. Now this is again an area of focus in terms of cost management on one side and chopping up of revenue on the other side. So it's a dual pronged focus which has brought these numbers, and I believe when we compare the top 6 private sector banks, our cost to income of 44 is just second to the commercial bank, which I think is a good benchmark to exceed during the or outdo in the next 3 quarters. The return on equity and return on average assets again has shown steady progress. On an annualized basis, the ROE has improved to 19.25%, and the ROA after tax group has exceeded 2% at 2.27, which is again in line with the medium aspiration, to move up from the traditional 1.25%, 1.5%, edging towards the 2%, and to on a sustainable basis to defend the medium to long term of 2%. This is something we have been conditioning ourselves internally, so it's the right start. The challenge is to now defend it throughout the next 3 quarters. The loan book, you've seen again, you can see the top left-hand side graph, which reflects a combined annual growth rate for the last 5 years around 20%. So it's a sustained story. And if we look at this year, the first quarter shows a 6% growth. And when we look at the top right-hand graph, you could see a number of negatives, and we are way on top at 6% with NTB right behind us and HNB behind. So I think it's an interesting start to propel the next 3 quarters. The combination of loans and advances, you see corporate and project finance still accounting for a total of 64%, while retail and SME accounts for 1/3, around 32%. So there is an ample opportunity and an invitation for the retail folks to improve their contribution and try to perhaps achieve a 60-40 medium-term mix, which is something we are encouraging them. But today, it appears that the corporate guys are doing something disproportionately well, which is something we are very pleased about. In terms of deposits, again, on a 5-year horizon, the bank continues a CAGR of 33% over the last 5 years. The first 3 months has shown a growth for NDB of around 4.5%, which is very much in line with our annual aspirations. We are, in terms of growth, number 2, just behind Commercial Bank. So it is something of a healthy journey and an interesting challenge to see what we can do in the next 3 quarters. CASA has shown a slight dip in the first quarter to around 24%. The medium-term aspiration is to surpass 25 and get towards the 30%. And we believe that the next 2 to 3 quarters will see an improved contribution coming from branches in the journey. Asset quality. The top left-hand graph shows the amber curve shows you the industry provision coverage, which has come down from 75% in 2010 to as low as 48%. NDB2 has reduced its coverage, but as a lesser tract, we've come down from 45 to 31. Sorry, I beg your pardon, it's the other way around. The industry has come down from 45 to 31, while we have reduced our coverage from 75 to 48. The coverage is well above the industry standards. And I think from a medium-term policy, we will focus on progressively improving this coverage. I think the medium-term aspiration is around 60%. Industry NPLs, we've seen it edging up to 6.2% at the end of this quarter. The bank's own numbers are at less than a half, at 2.7. So there's a lot of leeway, but we are not happy with the 2.7. We believe that we have scope to further improve this ratio to around 2.25, 2.3 for the full year, which is something we will be working on. You can see on the bottom left the various the balls showing where the peer group banks are. Ceylon is right at the top at 11.7, followed by HNB, Commercials and NTB, and Sampat and NDB are at the bottom at 2.4 and 2.7. So I think it's interesting to see Sampat also having improved its NPAs to a level around ours, so it will keep us on our toes to constantly improve and aspire to do better in that particular area of KPI. Capital adequacy has been one of our fortes. We've been extremely strong on the left-hand side, top left-hand. We can see Tier 1 and Tier 2. At a group level, the Tier 1 has been at 14.8%, and the total capital at just over 20%. The right-hand side graph is for the bank. Again, we can see NDB's total capital, the highest in the industry, at just around 18%, with NTB following us closely, further followed by Commercial Bank and Ceylon Bank. So I think that gives us a good cushion to take on the type of growth we aspire for the next 3 quarters, a good capital base. Going forward, we'd like to present to you 3 critical initiatives of deliverables for Q2. This, of course, shows you the 7 pillars which anchor the strategy for the bank. On the left-hand side, you can see the strong governance and risk management framework anchoring at the foundation, which is given shelter by the strong, profitable balance sheet growth. And then within that, we have, for the benefit of first-time participants, the 5 operating pillars of focusing on operation excellence, developing and continuing a strong sales culture. We believe among the local banks, we have one of the strongest sales forces, higher than average fee income, cost optimization, and best-in-class engaged and inspired team.